A big part of this are same-store sales. For the quarter, backing out fuel, almost 2%. For the whole year, you're seeing 2%. How sustainable are those same-store sale increases going to be?
Well, we feel very good about the momentum we have in our same-store sales and going into the rest of the year. We've made a lot of investments in the first quarter in redoing a significant number of stores. That's a headwind to ID sales as you have that many stores disrupted. Over 200 stores, or roughly 200 stores, we had in some form of remodel and space optimization that we called in the first quarter. As those stores start to mature and others come online, the effect of that headwind will start to subside, and as we get late in the third quarter, that'll in fact turn into a tailwind, we believe. You couple that with the great merchandising strategies we've had and exciting people to come to the store on a more regular basis. We think all of those together is what's going to drive the top line for the rest of the year.
Also looking into your margins here, if you take a look at, we have a Bloomberg chart here that shows your trailing 12-month gross margins coming in 22%. Your margins for the last quarter were right around that level, maybe a touch higher. Do you feel like the sales will pick up enough for you to grow your margins, or are you going to be using any kind of cash that you get to compete with Amazon and Walmart and therefore lower your prices, lower your margin?
Well, what we do on a daily basis is more than just compete with Amazon and Walmart. There's a wide spectrum of competitors that are out there. Over 40% of the share in the markets we operate in are held by other folks, not us or Amazon or Walmart or the stronger players in the market. And it's really about trying to make sure we're the best full-service grocery operator in every market we're in, and we're the #1 choice for customers when they come in. We've invested over $4 billion in price over the last decade plus, and we would continue to expect to invest part of the tax savings this year, as we discussed in March, in price, and we began a lot of that the last 5 weeks of this quarter, which actually also creates a slight headwind to sales because the retail price of those products go down. So we feel really good about the balance that we've struck so far this year. Part of the trick obviously is to continue to balance things. Started the year off with great cost controls through some process changes, got those savings in the bank, started to make the investments both in our price, both in our people, relative to they have more hours in certain service departments, as well as some of the other things we've done with the tax savings to further our associates' educations. If you've been with Kroger for at least 6 months and you're full or part-time, you can wind up getting $3,500 a year to help you further your college education. Took a little bit different tack than people just giving a one-time bonus. Yeah,
Mike, and that sort of goes to, it's not just wages, but there's other stuff going on there as a big employer. What's your biggest cost pressure right now?
Well, I think the biggest cost pressure is what we spend the most money on is associates and wages, and I don't necessarily look at that as a cost pressure. We've taken a proactive...
But is that rising, Mike?
It is rising, but we've taken a proactive approach in some of our contract negotiations with the unions, where we've wanted to raise opening wage rates for our associates and give them more dollars in wages and less dollars in some of the other benefits that the people just entering the workforce aren't as interested in. And what we've seen happen in a couple of the geographies where we've taken this proactive approach, yes, we're paying $1 an hour more for the associate, but we're seeing retention go up, meaning turnover goes down. And every time I keep an associate for a year, if I pay them $1 an hour a year and they make $2,080 more that year, I save more than that in what the cost of turnover is when you include training, hiring, the cost of doing all the drug and background checks that wind up happening.
Right.
So, and it winds up being a better experience for our customers when you have a more experienced workforce as well.
But give me the broad spectrum here as a CFO of Kroger. What's the biggest uncertainty you have right now? The biggest impediment to you investing money and growing the business? The thing you think about?
Right now, I would say that, technology talent is something that's difficult to find. Our IT group is a great group. They were recently named one of the top 100 places to work in the technology field in America by Computer World, which is a great recognition for them. Those kinds of things help you wind up attracting talent. But everybody out there in the country is trying to look for that talent.
Yes.
And as things become more technology-based and technology-driven, when you look at that recognition, when you look at the level of talent we have at our 8451 data analytics group, that 600 people wake up every day trying to figure out how to interact and make our customers' lives easier and give them a little bit more every day. all of those things added together is why we think the momentum we have is something that will certainly be sustainable.